Thank you, Minister, for your words. Particularly pleasing to see you framing the copper ecosystem in South Australia and also highlighting the importance of new discoveries and the role
I
that
don't see the
the
button.
department, in particular the Mineral
Or maybe
Resources
can
Division and the
you
Geological
share
Survey,
my screen, because I
plays
do
in
set my
growing that
PPT, or
sector.
maybe you play the
So our
PPT
next
for me.
speaker
I
is
give you a hint.
Yi Zhu. Yi is a senior analyst of metals and mining at Bloomberg
I don't
Intelligence.
see the
Yi
PPT
has more than
sharing.
15 years experience in the metals
Or
and
maybe
mining
you play the
sector.
PPT
And
for
prior to
me.
joining
I give you
Bloomberg
a
Intelligence,
hint.
he was a research analyst for Goldman Sachs and the Royal Bank of Scotland in Hong Kong, covering commodities. She also has a strong background in industry research, commodity trading, having worked for metal producers including Alcoa in the US and Shenhao Aluminium in Shanghai. We are delighted again to have Yi's insight in a global market. And just before Yi begins, I'll just remind you that we've got a poll question available during this session. Also, please remember, if you have any questions for Yi, just put those into the question box and we'll try and cover off on those at the end of her presentation. So hello, Yi from Adelaide, and over to you.
Yeah, hello, and thanks for the introduction. It's my great pleasure to join this event again this year, and thanks for the opportunity to share with you my analysis and outlook for copper. So today, my topic is how Russia-Ukraine crisis may impact copper outlook. So I'm organizing my presentation into 3 parts. So next slide, please. We'll first take a closer look at the impacts of Russia's war on Ukraine to commodities, especially copper, and share with you our 3 scenarios about the price forecast within the next 12 months. Then we look at a longer timeline and examine the mega trends that could drive copper's demand in the next 5 to 10 years. Finally, we talk about the supercycle topic, which has been under discussion for a while. That is there a supercycle for copper? So next slide, please. The invasion of Ukraine is injecting historic volatility across a wide swath of commodities because of surging geopolitical risk. A heightened possibility of supply disruption, logistic issues, and the increasing commercial isolation of Russia after heavy sanctions from Western allies. Can I ask for next slide, please? Sorry about we have a little bit technical issue. So metal prices increased in different extent based on the percentage of Russia's supply of the global total and their individual supply-demand situations. But now, the metal markets are showing some signs of settling down post the initial price hike, and prices remain volatile. So on this chart, we put blue bar to represent the Russia's percentage of global supply and yellow bar as year-to-date price performance. And we can see nickel still has the highest year-to-date price jump after a big short sparked the crisis, and prices are stuck at historically high levels that have become detached from the real world of the nickel industry. And for our copper, its prices have dropped after the jump and retreated to even below the beginning of the year, as investors are increasingly focused on the downside risks for industrial metals, from US monetary tightening to shaky European economics and China, the large consumer who is fighting the COVID outbreak. So next slide, please. Um, so where copper or commodity prices will go in the next 12 months? Due to all the uncertainties, such as the seemingly protracted conflict between Russia and Ukraine, the COVID-led transportation curbs in China, and its unknown impacts to supply and demand, we've contemplated 3 potential geopolitical pathways and outcome ahead, which are ease, extend, and escalate. So for ease scenario, we assume rapid disengagement and full withdrawal of Russian military troops from Ukraine. Russian metals flow unencumbered through trade channels in this scenario, with US and the EU companies re-establishing full commercial relations. And we think copper could fall to 8,500 a ton, especially as new mines are commissioned in second half. And under the extend scenario, which is the key assumption underpinning our base scenario. Russian metal flows are impended, with a greater portion being rerouted via China, stifling the urgency to build more domestic capacity. And we put copper's average price at 9,000 to 9,500 a ton over the next year, with only some of Russia's copper tonnage being re-exported via China. And China's stockpiling metal will tighten world markets, supporting LME prices. And under our escalation case, which is also our price upside scenario, is predicted on worsening Russian military aggression in Ukraine, forcing a heavy-handed economic response from Western allies to exact maximum cost from Moscow. So we anticipate soaring energy prices, partly curtailing Europe's copper mining industry, centered on KGHM's Polish operation of 400,000 tons and Aruba's German and Bulgaria smelting operations. And copper may be vulnerable to partial closings, and an average of 11,000 a ton is possible, especially if China holds Russia's 900,000 tons of refined copper. So on the next slide, we are showing Bloomberg's consensus from sell-side analysts on copper prices. We expect economic shocks from Russia's Ukraine invasion could inflict a lasting sting on metals markets, and the impact may linger for years. And the three scenarios we just showed may unfold over the next 12 months, all shaped to varying degrees by restricted or rerouted Russian metal flows, higher energy prices on European metal output, and falling demand. And on the next slide, so China's downstream semi-manufacturer operating rates have fallen modestly, which you can see on the left chart, because the country's COVID-19 lockdowns affected logistics of smelters and processors. Shipments of refined copper from smelters to processors and delivery of final product to downstream customers are being affected by transport curbs due to the virus outbreak, dragging down operating rates at producers. And after operating rates are seasonally adjusted, the outlook is much weaker, pointing to softer demand as well. So while manufacturers' operating rate trend by rising, potentially foreshadowing higher cable demand as infrastructure spending picks up. And on Chinese spot copper TC, which we show on the right-hand chart, have risen sharply over the past month, reflecting both smelter demand uncertainty, with operating rates have fallen to 85%, and increasing mine supply in second half as new mines open. The combination of lower smelter demand, improving mine output, and increasing concentrate complexity could signal a further increase in spot TC. And on the next slide, here we estimate that China's output of refined copper could rise 4% to 10.3 million tons this year. That's on the left chart, as new capacity from smelters are commissioned. And the growth rate would be slower than last year's 7% year-over-year growth rate. And on the right-hand chart, we are showing China's monthly copper output. We expect the monthly refined copper output will fall about 1% sequentially and 4% year-over-year in May, and hit the lowest level of this year, as major smelters such as Chifeng Yunnan Copper, Dayan Ferrous, and Zijin Copper conduct maintenance checks. And the reason May output could be the lowest at this level this year, because the halted smelter in Shandong could resume production as early as in June, and China's new capacity will ramp up in second half. But demand for refined copper in China has been relatively weak this year, even as prices advanced globally before April amid fears of a shortage. And China pledged an all-out push for more infrastructure construction last month in a bid to refire growth that's been hammered by Omicron spread. Strengthening infrastructure construction in an all-round way is of great significance to ensuring national security, expanding domestic demand, and other objectives, according to this announcement. But what we see on the metals market is the metals market barely registered the remarks, with SHFE copper futures rising only very slightly on the following day of the announcement. So we expect copper prices to continue to be pressured in the next 3 to 6 months. And after talking about the short-term outlook of copper, now we move on to the next slide to look at a longer timeline and examine the mega trends that could drive copper's demand in the next 5 to 10 years. So next slide, please. This slide, we are showing the decarbonization. So even after factoring in higher substitution losses, decarbonization and energy efficiency may result in copper demand increasing at a compound rate of 2.6% a year versus the past 2 decades at 2.2%. So you may think this seems insignificant, but the green market boost comes just as China's demand growth has reached maturity. We expect the appetite for copper in the green segments of electric vehicles and renewable power generation could boost the overall need for copper by 7.9% over the next 10 years. And those areas where energy efficiency requires a great amount of copper, such as motors, air conditioners, and transformers, could drive up demand by 3%. And on the next slide, we are looking at electric vehicles specifically. So we expect EV to drive copper demand by 2035. The global vehicle sales may still be short of pre-pandemic levels by this year, and auto-related copper demand could exceed that of 2019 due to the tripling of EV sales since 2020. EVs are set to account for about 3 million tons of demand and almost 60% of all transit usage. And we expect plug-in vehicles and battery electric vehicles could reach 27% penetration by 2030 and 40% by 2035. And the next slide, we look at the power generation, which makes up a modest 5% of global copper demand. But clean energy capacity additions could boost the subsector appetite for the metal by 5% compounded over the next 10 years to about 1.9 million tons by 2025. We estimate that copper demand in clean energy technologies may double in 2030 versus 2020 levels. While this is significant and represents about 10% of world copper demand, or an incremental 1% per annum, China's growth trajectory remains far more significant. And next slide, let's look at the long-term trend of rising copper demand across consumer durables, industrial machinery, and the heating and cooling sectors remains intact due to energy efficiency demands and rising income levels in developing countries. So China's air conditioning market may pose a downside risk this year, we think, given the property sector slowdown. And minimum energy performance standards in copper-intensive sectors globally could increase the metal's intensity by 0.2 to 0.5% a year. And this may not sound like much, but it may have a multiple effect by boosting replacement cycles. We estimate copper demand in these 3 sectors could surge by 1/3 across the next 10 years. So overall, we expect that green demand and energy efficiency may result in copper demand increasing at a compound rate of 3.2% a year versus the 2.9% long-term trend since 1950. And last but not least, let's move on to the next slide to talk about the supercycle topic, which has been under discussion for a while and brought up whenever copper prices move in a large extent. That is there a supercycle for copper? So to answer this question, let's look at the history first. So on the next slide, you can see on the chart, we are showing LME copper prices, both real and nominal. So in the past 150 years, we believe there have been three major metal supercycle phases. The first arrived in the late 1800s to the early 1900s, driven by the US economic boom. And the second was driven by post-war reconstruction from 1945 to 75 in Europe, and later by Japan's massive economic expansion. And the final and most recent metal supercycle from the early 2000s to post-financial crisis was driven by China's massive urbanization and industrialization growth. And all three supercycle periods coincided with high and rising intensity of metal use, which we believe as the most useful indicator of a supercycle. And in the past 2 decades, China's intensity of use surged to drive its annual demand across most metals to around 50% of the world's total. That compares to only 15 to 20% in 2000. So as China's growth model shifts from the investment-centered to consumption-driven, we think the demand growth of metal will slow down, but its intensity of metals use will grow. So next slide, we look at, so beyond being an essential metal in decarbonizing the world, a commodity-intensive infrastructure rebuild as part of the pandemic recovery, combined with China's relatively low intensity of use, could support medium-term demand growth. And a keener focus on the environmental impact of mining activities has left the industry unable to respond quickly to market deficits through new supply, despite the price being well above an incentive price. So we do think there is a bullish market for copper, but not a super cycle. Next slide, please. Because on the demand side, copper lacks post-China super cycle drivers, and no other countries can take the torch from China yet. Next slide, please. Thank you. India's population is similar to China's and has often been identified as a potential new demand sources. But the issue is India's metals consumption pales in significance to global demand compared with China, which in our view makes it more difficult for India to make a meaningful impact. Seems we have a little bit technical issues. Can we? Yeah, so this is the picture I was just talking about. So you can see the India demand and versus all other countries' demand we just talked about. Okay, now let's move on to the next slide. So looking at the macro side, if the copper to crude oil ratio is a guide, so market expectations for about 200 BPS of Fed tightening in the coming year may be excessive. So spiking energy prices are squashing consumer sentiment, and the economic repercussions are resonating in the declining price of copper. This is part of the lose-lose for commodities, which is higher crude oil is increasing inflation and forcing central banks to act more aggressively. So on this chart, we depict an enduring trend, which is the rising ratio of copper versus crude oil backing into a good support zone. And in the meantime, the spread between the front federal fund future versus a year out is priced for the most rate hikes since the contract gained liquidity about 20 years ago. And June 2008 was the last time tightening expectations and the copper to crude ratio had a similar disparity. The price of Dr. Copper appears relatively extended versus more rebound global consumer sentiment. So unless there is a quick resolution to the war in Ukraine, a reversal in spiking energy prices, and central bank restraint, we think a recovery in sentiment seems unlikely. The greater potential may be for prolonged gloom as the world tilts toward recession. And we see parallels this year with rising crude oil, natural gas, and food prices weighing on consumers. For longer term, we think copper has the demand side advantage, given electrification and decarbonization trend we just mentioned, so which are replacing fossil fuels. So let's move on to the next slide. So let's talk about the topic globalization. So globalization, as we've known, it has become precarious since the pandemic and Ukraine war, with nations reassessing how to allocate their natural resources. And we think a less connected world may be one of local supply chains and a greater focus on domestic resources. Commodities may emerge as the dominant trading theme to capitalize on the shifting world order. So global trade patterns may look different the rest of this decade as localization displaces globalization. And complex supply chains have fostered years of low-cost, high-efficiency production, but supply chain shock from the 1-2 punch of pandemic and the Russian sanctions has shattering global integration. So this may compel multinational corporations to shift their sourcing priorities from cheap and easy to dependable and reliable. So the change is evident in the proportion of world export as a percentage of GDP growth, which we show on the chart, which fell to 26% in 2020 versus 29% in 2018. History suggests commodity prices track global trade flows closely, but they may not follow the typical playbook. And we think the shortages fueled by supply shocks and Russian sanctions will persist. And the departure from globalization would boost prices higher for longer because the globalization may also prompt nations to step up development of their homegrown natural resources, especially as they wean themselves off imports and price volatility. But the production learning curve lurks in the form of higher operating costs. So rising investment requirements and soaring marginal cost of production may justify higher prices. On the next slide, let's look at the capex. So we think capex in the copper industry is rising. It may still not be enough to fill the potential deficits in the market towards the end of the decade. Because out of the total spend, just a small portion, we calculate at 30% this year, may contribute to adding new capacity after accounting for sustaining capital and combating grade decline. And we calculate the capex of top 50 mining companies, including both copper pure plays and diversified miners, would rise this year, but still below the previous peak. And we see net debt is falling quickly, despite rising capital spend, suggesting the sector has plenty of balance sheet flexibility to increase capital spend further. And copper projects also have to compete with other future-facing metals, such as lithium and potash, for capital at the diversified miners, which is why we believe the overall portion of capex allocated to copper may not increase significantly above 40%. And on the next slide, we look at the greenfield projects. So we do expect greenfield projects will add to copper supply in 2022 to 2025, but increasing technical complexity and approval delays could lead to a dearth of shovel-ready projects in 2025 to 2030. Next slide, please. And the average lead time from first discovery to first metal has increased by an average of 4 years to nearly 14 years now. Increasing social and environmental awareness means that mining companies need to engage communities and governments very early in project development. And in recent years, major miners have focused more on shareholder returns rather than new capacity, which in the current market suggests some level of underinvestment. So we estimate that extended approval timelines and potentially higher taxes in Chile and Peru mean the copper industry may deliver just 1.5 million tons from greenfield projects in 2025 to 2030, with about 50% of the potential identified supply likely to hit the market after 2030. So unless a number of projects are fast-tracked, the copper market may see a period of deficits in the middle of decade, when demand from electric vehicles could be a tipping point. So to summarize my presentation, we expect short-term copper prices have downside risks due to fears of rapid monetary tightening and deteriorating demand from top consumer China. And long-term, as an essential metal in decarbonizing the world, a commodity-intensive infrastructure rebuild as part of the pandemic recovery, combined with China's relatively low intensity of use, we think copper's demand growth picture looks promising. And a keener focus on the environmental impact of mining activities has left the copper industry unable to respond quickly to market deficits through new supply. So we think there is a bullish market for copper in the long term. So this is the end of my presentation. And now let me pass the mic back. Thank you.
Side across a whole range of topics. Sorry, I'm just getting a bit of feedback here. Let me just fix that. There we go. Thanks for that. Really just interested in that whole shift to domestic supply and security. So sort of that localization versus globalization is really an interesting topic for me, and something that, you know, we've heard about across a range of commodities, but, you know, to hear it talked about from a copper perspective as well is really quite interesting. We've got some questions have come through from those online. So if you've got a few minutes, we'll just we'll work our way through those. So our first question is, how much flexibility is there in the refined copper production in countries outside of China to respond to the drop in China's production due to COVID?
We don't think there's much flexibility, because I have to say, if we look at Europe, it has the energy, like higher energy prices. And for China, we think the loss of the refined copper production is actually short term, because like the May output drop was due to, you know, the halt of the smelter in Shandong, and also due to the transportation curbs. But we do think China's COVID outbreak can be controlled soon. So that's the reason we expect production would come up in June. And together, the smelter, which paused production in Shandong, would resume capacity. And also, if we look at the smelter specifically, have to say their production hasn't been impacted much by the COVID outbreak in China versus, say, downstream. Because for smelters, we all know that they have certain days or maybe months of the inventory for raw materials. And most plants, as we do our channel checks, they do arrange workers maybe stay in the factory. So smelter side, we don't see much like production impact from the transportation curves. But just have to say, if the COVID lasts longer, then we may see the transportation curves hurt the delivery of the raw materials into smelters. And of course, the transport out of the refined copper to their downstreams. So we think China itself would make up the shortage like during May, for May. So like in the later months. And also we are seeing new capacity addition in second half. And overall for the whole year, as we forecast, we do forecast China's refined copper output continue to grow this year, just as a slower rate. That's because last year's almost 7% year-over-year rate growth was due to the low base in 2020, which was hit by the COVID. Yeah.
Excellent. Thanks, Yi.
Mhm.
So our next question, what will be the impact of copper recycling on copper supply up to 2030, given electric cars will have shorter lifespan than infrastructure use of copper?
Mhm. Sure. Yeah, we do see a rising usage of the recycled copper, maybe especially in China, because we all know before China doesn't have enough, say, the inventory for the obsolete items. So that's the reason we rely a lot on scrap copper. And I think if investors follow like scrap copper continuously, you will know China has now toughened the import requirements for scrap copper. So which means if copper meet the required standards, actually there's no import quota. But if for scrap copper, which was the low quality, then of course, no, they cannot be imported. So to address that problem, so we are seeing a lot of, say, Chinese investors or maybe just other investors invest in Southeast Asia to build those scrap yards to process the scrap copper. And we are seeing the overall trend of the import of scrap copper would increase over the next, so maybe in the rest of the decade. And that's also China's emphasis on carbon neutral, the push, because using scrap copper is less, consume less energy and less polluting than we just refine copper from the copper concentrate. And for the output wise, I think CNIA, the China's non-ferrous China's non-ferrous metal industry also put out some like production target for the recycled copper. So the overall trend is increasing. And within China, we are seeing scrap dealers are increasing their production scale. Because I have to say, before the scrap dealers are very individual or diverse and with relatively low level of regulations and very smaller like production scale. And now with the government pushed M&A, government pushed like to growing the industry, we are seeing these scrap dealers or scrap yards are growing in the production scale. So yeah, so back to the question. So as overall, yeah, we do think the recycled copper usage would increase. Yeah.
Okay, that's great. Well, you've certainly woken up the chat because we've got a couple more questions for you if you have time. This
Yeah.
is a really South Australian centric one, so that's great to see. How can South
Yeah.
Australia capitalise on the likely trend to localise copper production, and what levers can be applied to support groups setting up processing capability?
Uh, wow, that's a good question. I just speaking out of my mind because and I have to say, as an analyst, I haven't done my field trip to South Australia yet, especially to Adelaide. So I'm just speaking. So of course, we all know like Australia is the one of the largest producer for copper concentrate. I think for the localization, yes. So of course, if you can build the smelting capacity, that's perfect. But then, as the reason I just mentioned, so I have to say, build the processing. So first is there really demand for that? And second, of course, it needs investment and also needs time to accomplish that. To it need time to complete the construction of the smelters. And the third is why the reason or why China is the largest producer of refined copper is because the production cost is relatively cheap. So if it really build it in South Australia, so how about the production cost? So I'm sorry, but I haven't done my maybe research on that. I think I may need some data support. So how much is the production cost, and how is the environmental regulations about that? Because we all know mining or smelting is sometimes do have like certain environmental impacts. So how you value that? So but that could be the trend, because if deglobalization is happening, and that's the best way to safeguard the production of the old materials. And since Australia already have the raw material, and smelting is the next easy solution. Yep.
Uh,
So,
that's a great
and maybe
response,
I
and
can.
that's sorry to put you on notice, and we'll have to see what we can do about getting you to South Australia at some stage in the future, so you can expand your knowledge on the South Australian copper
Yep.
industry.
Yep, thank you. And maybe next year when I join again, I can answer that question in very thorough details of the data and analysis.
Good stuff. We've got a couple more questions if you're keen to stay online and answer those as well.
Sure.
How will ESG affect
Mhm.
the sources, e.g. Russia, for future copper?
Yes, it will definitely impact, because we are seeing Western countries are sanctioning Russia, and that's the reason we expect maybe certain amount of Russian metals may reroute to China. But of course, the metal flow is never predictable, because it depending on the price, depending on the availability, and depending on what our traders think. So we do think the ESG part would impact that amount. And I do think the pricing behind it would be the key driver. So say, for example, Russia now has the alumina shortage. I know, yeah, maybe aluminum is another topic versus copper, but as alumina, which is a raw material for aluminum. So Russia has the shortage of alumina because Australia banned export, and also its own alumina refinery in Ukraine was paused production. So we are seeing China exporting alumina to Russia to fill that gap. And we do think if the ESG part of impact to the Russia is, as long as Russia smelter is still producing, those metals would definitely find a way to go out. Whether it's maybe we talked a lot by rerouting China because seems it's a easy solution, or it may go out from certain ways. Yeah.
Excellent. And you've sort of partly answered this question already, but have you looked at potential for substitution of other commodities such as aluminium if the
Mhm.
copper to aluminium price ratio gets too spread? You sort of touched on this a little bit, but can you expand on that one a little bit more?
Yeah, sure. So I think aluminum substituting copper is always the topic, because I have to say aluminum is cheaper than copper, especially for using it to cable. But I think first is, do we really have the technology? Because I've been following this topic for a long time. As I used to work for Alcoa. So the technology part is difficult. And because and I look at a lot of China. So I have to say China itself doesn't have much technology to do that. Or if China does, then the cost about doing that would be really expensive. So we are seeing this topic has been talked about for at least a decade, but not much has been done. And of course, that again depend on the price ratio. So say if copper is way expensive than aluminum, then the substitution could happen. But since the Ukraine war, we are seeing both copper and aluminum prices go up. So I do see this could be the future trend, but have to say the current substitution amount won't be much. And if it's only say maybe say 10,000 tons or maybe a couple thousand tons, if we compare it to the whole copper demand, that isn't much. Yeah.
Yeah, excellent. Thank you.
Yeah.
Well, that's the end of our questions. So thanks again, Yi, for your time and your insight into global commodities, and just highlights how complex it all is really. So thanks again for your time, and yeah, hopefully we look forward to seeing you in the future.
Yep. Thank you.
So just a reminder that we have the poll running, so feel free to drop in and respond to that. But also, I've been advised you need to close out of session 1 and then enter into session 2. And we're going to have a 5-minute coffee break So we'll be back online in 5 minutes. So thank you again, Yi, for your time this morning, and
Thank
really
you.
appreciate your insights. Thank you. And
Thank
for
you.
everyone else, enjoy your 5-minute break, and we'll see you shortly.